Okay, I just want to welcome everyone to our webinar today, where we'll be starting shortly. And if you just joined us, go ahead and put in the chat room where you're calling in from. Again, just want to say we appreciate you taking the time to join. We've got a great lineup of speakers. We're going to be covering the whole startup journey. And just a little background on how the webinar came together. When we were in the planning phases of the webinar, we really wrestled with the idea that this topic would be too broad. However, when we considered the depth and the experience of each of our speakers and their specific focus on the startup journey, we saw a connected theme. And so we thought, let's put these all together, bootstrapping, fundraising, and the financials necessary to raise a future round. And let's try this webinar. And so as we've been planning on it, we just saw that there's really something here to bring to the our founder community. So we're going to have Mike Moyer kick us off in a few minutes. Mike is a professor. He's also the CEO and founder of Slicing Pie. It's one of probably the most successful softwares out there, helping early stage founders who are in the bootstrapping stage. Mike's going to present a model that creates a perfectly fair equity split in the early stage, and also talk about some compensation models. And then Chris Lustrino, CEO and founder of Kingscrowd, he's going to introduce the audience to some recent market trends in equity crowdfunding and share insights on how startups are really taking advantage of raising online capital in parallel with family and friends and angel rounds. One of the things that we've seen in the marketplace is that about 99% of founders aren't able to access funding from angels or VCs. So they're resorting to family and friends, credit cards, or home equity lines of credit, which isn't always the best way to set up launch a company. So Chris is really going to provide some great insights into how to look at how equity crowdfunding allows the founder to set more favorable valuation terms, and also open up a whole new audience of investors who can oftentimes become product ambassadors. And then Logan Burchett's going to wrap up the webinar. Logan is the COO and co-founder of Forecastr. And Logan's going to provide actionable insights on how to make strategic choices to drive growth and long-term success. Logan has a real deep background in helping kind of with CFO type work. And their company has created some great resources to help kind of more later stage founders to go on to raise multiple rounds. So with that, I think we're going to go ahead and kick it off. We still have people joining us. Thanks for putting in the chat where you're calling in from. But Mike, why don't you go ahead and kick us off?
One thing that's I want to highlight before I started talking about Slicing Pie is how to think about the different types of investors, and then how to think about the three guests we have today, including me, and where in the process they come along and where you might need them. So a founder is someone who I define as someone who's directly participating in the business and foregoing current compensation and reimbursement of expenses in exchange for equity. So this is your bootstrapping team. The next group of people is called an angel or friends and family. These are people who invest their own money in amounts that are too small to fund your operation. So they're putting in 5,000, 10,000, 50,000, maybe significant cash, but not enough to pay all your founders a salary and pay all your expenses. So founders are still foregoing current compensation and reimbursement of expenses, but angels and friends and family, they're investing their own money. The community are people who like you, are aware of you, and want to see you succeed. And this is where this is your customers, your contacts. These are people who might be potential crowdfunders. And the last group of people is someone who invests other people's money in amounts that are large enough to fund your operation. These are venture capitalists. The difference between a VC round and most other rounds is that a venture capitalist is going to put a valuation on your firm, and they're going to invest at a valuation, and they're going to put enough money in there to substantially pay your salaries and expenses in the foreseeable future. Whereas angels, friends and family, community rounds are generally best served in the beginning with a convertible note, and the other guests can confirm or deny that. That's just kind of how I teach the different funding rounds to people that I work with. So when you think about what we're doing today, the bootstrap stage, I think about people as placing bets. I'll talk a little more about that later. When you contribute to a startup and you're not paid and you're not reimbursed for expenses, you're essentially betting on the future outcome of that company. So your contribution is basically a bet. When you're an angel round or a crowdfunding round, convertible debt or a safe note is probably the best tool to use. The reason this is such a good tool is because you don't have to place a valuation on your company. It's also less paperwork, it's a lot less expensive to execute. So an angel round is not very regulated, and it's basically a private deal. You can go to your mom and dad and say, give me some money, and they'll give you money. You don't even need to have a deal. But most angel rounds will have to take a convertible note or a safe note, which is a simple agreement for future equity. Your crowdfunding round, you can go out with a debt round, but it's more regulated and it requires a Form C, and we'll talk about that, I think, this hour. It's a public filing. So when you do a crowdfunding round, it's a public filing, so it's more paperwork involved. And a Series A round is a very expensive round that requires a private placement memorandum or PPM. And it can be a private deal, but there's a lot more work involved in it than typical deals. So think about the evolution of your investors and your investment journey as angel rounds, crowdfunding, and Series A in that order. And most of your funding these days comes from angel rounds and crowdfunding. And of course, revenue is always the best funding for most startups. So when it comes to dividing up equity, as in the bootstrap round, where I play a lot in my time, most companies do equal splits. So everyone will get X% of the company. They'll divide it by the number of founders. This is a very common scenario. It's at a glance seems okay, and it's what most common strategy for startup companies. The problem is, what if you do all the work? Or what if we bring in another guy, and maybe I'm a marketing person and you're a tech person, you bring in a developer. That person's going to help you, not me. Or what if you want to quit? Or what if I want to quit? Or what if your CTO gets hit by a bus? There's a million things that can change about what you originally expected from your business. So when you do equal splits and something changes from what you expected was going to happen, that's going to be a problem. Doing equal splits, doing any fixed split out to the outset of your venture means you're anticipating things that are going to happen. So an equal split assumes that you're all going to do equal splits, which you're all going to do equal amount of work, which is rarely the case. So everyone's going to be upset. There they are, pissed off. So I call this a fix and fight model. You've set your equity split in advance, and then when things go differently than you expected, you fight about it later. And when you fight about it, you hire your lawyers, and you engage with lawyers and fight with people, and then you go back to getting another fixed split, which is not fun. If it's not fair, it won't be fun. In my perspective, when you do a equity split at the outset of the venture, based on assumptions about future events, there's no possible way for you to get a fair split. It's just impossible to get a fair split. If you have a fair split, though, it'll be fun. So the best way to think about fair splits is through a game of blackjack. Mike Van, do you know how to play blackjack?
I do. In fact, I love it. I've probably lost more money than I could admit.
That's a typical entrepreneur for you. So let's pretend that you and I are going to play blackjack together as a team, not opponents, as a team. And we're going to split the winnings 50-50 because we're friends. All right? Do we have a deal?
I love that deal. Yes.
Right. So 50-50. So we go to the table and I put a chip down and you put a chip down. Now, we don't know if we're going to win. We don't know how much we're going to win. We don't know how long it's going to take to win. The future is unknowable. We cannot predict the future. What we know for certain, though, is that you bet one chip and I bet one chip. So the dealer deals an ace and another ace. What would you do if you had two aces, Mike?
I would double down.
Split the aces and double down. Except I'm out of chips and you're not. So you put two more chips down to cover our bets. So you've covered our bets with two more chips. So now you've bet three chips and I've only bet one chip. The future is still unknowable. We don't know if we're going to win or how much we're going to win or how long it's going to take to win. We can't tell the future. What we know for certain, though, is that you bet three and I bet one. If we win, does our deal for 50-50 sound fair?
Hmm. Yes, it does.
Does it?
No,
We
that's my
agreed to it.
that's my poker side.
So it might not matter if these chips are worth $1 each. If they're worth $100,000 each, then it really matters. What you should observe here is that your share of the winnings should reflect your share of the bets. You should get 75% and I should get 25%, because that's how much we each bet. So
Yeah.
in business, it's the same thing, except cards, we're betting on ideas. We bet time and money and facilities and supplies and equipment. And whenever we are betting, we're betting the fair market value of the contribution, the unpaid portion. So if you contribute to a startup and you're not paid, you are essentially betting exactly the fair market value of that contribution. And a person's share of the equity should be based on a person's share of the bets. So what slicing pie simply does is it keeps track of who bet what and divides the equity based on the bets. So in this case, everyone bets slightly different. Person A, the woman with the red share, she bet more than person Y with the blue share. So maybe she put cash up and maybe she spent full time and quit her job, or person Y is simply an advisor. Things change over time. As things change, the slicing pie model automatically adjusts to stay fair. It is a one-size-fits-all solution for the allocation and recovery in an early-stage bootstrap company, which means that slicing pie works for tech companies in San Francisco, fishing companies in Botswana, restaurants in Europe. No matter where you are, no matter what you're doing, it's a universal application of what's fair in the bootstrap equity split. So when you think about your equity split, rather than thinking of fixed split and what people are going to do in the future, think about what have they done and what are they contributing in real time. And so slicing will self-adjust to stay fair no matter what changes. So that's the basics of how slicing pie works. I've written several books on this topic. The Slicing Pie Handbook is the main book on it. The book's been translated into dozens of different languages. I have software online. There's online courses, lawyers. You can consult with me on using this. There's events like this one. There's free downloads. Slicing Pie is a free model to use. There's things to buy, but for the most part, I want to provide a fair way of dividing equity in early stage startups. The past 10 years, thousands of startups have used this. I've talked to thousands of them personally, and never once have I heard it backfire when applied properly. So that's how slicing pie works. That's the first step first thing you should use when funding your company at the bootstrap stage. If you have any questions about it, please email me at mike@slicingpie.com.
Great, Mike. Thank you so much. Wow. It's always good to just to go back to kind of the foundation of how a startup needs to be built. And Mike, thanks for that presentation. And stick around because Mike's going to give a special promo webinar discount for attending the webinar. So now I'd like to introduce Chris Lustrino, the CEO of Kingscrowd, and he's going to take it away and focus on equity crowdfunding and how it really is. It's becoming more and more a instrumental part of the capital stack. Chris?
Yeah, absolutely. Thank you so much, everyone, for joining us today. I'm really glad to be here with you all and have an opportunity to share some insights with you. So if you're on this call, you're likely a founder. And if you're a founder, you've likely had to raise money, need to raise money, or will raise money, and probably all of the above in that, a founder's job is to make sure, number one, above all else, never run out of money. And thus, thinking about your capital raising strategy, right, is really, really important. So at Kingscrowd, we're focused on basically providing the most comprehensive data solutions for the regulation crowdfunding and regulation A+ equity and debt markets. For those who don't know what that is, right, it goes to a little bit of what Mike was already hitting on. It's the crowdfunding industry. It's where you can raise capital from the general public. Under regulation crowdfunding, you can raise up to $5 million from an unlimited number of investors, regardless of whether or not they are a millionaire, aka accredited, or not. Under regulation A+, you could raise up to $75 million per year from the general public while remaining private from anybody, regardless of accreditation status. To be really clear, until you're a later stage company, you probably have a CFO and large legal counsel in place, regulation A+ isn't going to make so much sense. But Regulation crowdfunding is a really powerful tool for raising capital to get your business off the ground and to continue to grow it for many years to come. So today we're going to be talking about regulation crowdfunding, equity crowdfunding, what it looks like today, how the market's doing, does it make sense for you, what are the benefits, what are the downsides or challenges, and what are the things you need to be thinking about if you're a founder and considering whether or not crowdfunding makes sense as part of your capital raising strategy. And from my own purview and lens, I would argue that raising capital via Reg CF is something that fits nearly every business type and should be something considered as part of your overall capital stack, regardless of stage, industry, so on and so forth. And I think we have a lot of data to support that. So having been in the market for the past 7 years, tracking quite literally 100% of Reg CF and Reg A plus equity and debt offerings, we have a really good sense of what's going on in the market. And then I also have my personal experience of having raised over $7 million from over 4,000 individuals to grow our own business under Reg CF, Reg A plus, and Reg D 506C, which allows you to raise only from accredited but solicit online. So I'm really kind of in tune to what all this looks like, and I'd be happy to chat with anyone after this if you have more questions. So what is equity crowdfunding, Red? I already kind of hit on it. So more what I'm going to dive in on is what does equity crowdfunding look like? Is this a viable path to raise capital? Well, there's been over 9,000 companies that have raised well over $2 billion under Reg CF cumulatively from 2016 to 2024. When I started this company in 2018, don't quote me on the exact number, but there was likely somewhere around 50 to 100 companies that utilize regulation crowdfunding. This year alone, there'll be somewhere closer to almost 2,000 unique companies raising capital under Reg CF. And that includes a mix of companies from what I call day zero companies, right? Your Y Combinator, I have an idea on a piece of paper, but zero traction, just an idea in a team, and we're going to go for it. And we have companies with over $300 million in revenue that are planning for an IPO within the next year and everything in between. So this is a market that services a lot of different types of companies. And again, very simply, many, many, many companies. The key marketplaces, largest marketplaces out there, I shouldn't say key, some of the largest marketplaces you may have heard of are Start Engine, WeFunder, Net Capital, and Republic. But there's nearly 100 marketplaces where you can go and list your company under regulation crowdfunding and raise capital from the general public. And there's many different reasons to pick and choose amongst the various different platforms out there. And certainly working with the largest does not always make the most amount of sense. And there's a lot of thought that goes into that as well. So what does it look like for individual companies, right? On average in 2024, we've seen the amount raised hang somewhere around $366,000 per company. The average check size is around $1,190 per investor. The average number of investors in a deal is about 408. And typically it's taking about 4 months to run a full campaign. And typically it takes about 2 months to get a campaign up and running. So I always tell people plan for about a 4 to 6 month process to run end-to-end a Reg CF campaign. Now, when you get into the median amount raised, actually, it's only around $130,000 raised per company. And that's something I'm going to get into more detail in a couple of minutes on. There are many notable Reg CF raises out there or crowdfunding raises. Alto IRA, you may have heard of Mercury Bank, right? Backed by A16Z and NEA. They raised $150 million or so from those big guys. And then they raised $5 million in a matter of seconds from their own customers. Customer.io raised a bunch of money at a $400 million valuation on Republic. Really powerful kind of new CRM solution out there. And they went on and raised a major private equity round only a year or so later. Revolut is a company that's been getting a lot of news recently. Their initial investors out of the UK and their crowdfunding laws. Actually, it's no longer 100% paper gains. It's almost 800% actual gains for Revolut investors. I think people who put in $100 are getting like $80,000, something crazy. But Revolut investors are doing quite well who invested in their first crowdfunding round in the UK right now with a secondary sale that's going on. And I say all of that to help present the picture of, some people still think crowdfunding is kind of like the Wild West and it's all bad companies and no one cares. And none of that is true. This is really becoming a mature industry with a plethora of companies across the entire spectrum of types of companies that exist out there. So what are the benefits of equity crowdfunding? The benefits are that you get control, right? And I kind of shout that from the rooftops because control means a lot of things, right? It means not adding a board seat. It means not giving away preferred shares. It means not giving away liquidity preferences. It means not having to respond to or answer to a board member that wants a sale in a certain period of time for their own fund, right? Or ultimately decide something against the company because it's in the best interest of their fund, right? When venture funds come into your business, they have their own objectives and end goals, and they're not the same objectives and end goals of a founder. And I think that's really, really important to understand. And it's not just about setting your terms and valuation. That's only a part of it. Again, it comes down to control of your company. It's them saying you need a co-founder or a certain person in one of those seats, or that you need to have certain meetings with them so that they could decide whether or not they want to continue to fund you. There's all sorts of strings attached with traditional venture capital investing. And you have to ask yourself, when do you want to do that? Do you ever want to do that? And what does that mean to you, right? So control means a whole lot of things, but by not giving up that board seat, not having to answer to those folks, you really get to be the entrepreneur you want and build the business you want. And there's so much power in that, again, beyond just the valuation. And oftentimes venture investors could come in and actually give you a more attractive valuation than you can maybe get in traditional crowdfunding, because they're willing to pump you with more money and whatnot, but then they expect more speed and more spend and have you run off the cliff faster. And if it works, great, but if not, you go down in the hole, right? So there's a lot to be said about control. And I just want you to take that from a comprehensive view, understanding that you continue to control your business matters a lot if you care about your business for the long term and have a certain vision for where it goes. Success is not binary, right? Oftentimes when you go out and you do a traditional venture round, it's either like 1 or 0. You either succeed or you fail. The beauty of this space is, hey, maybe you went out and shot for $1 million and you raised 300,000 or $500,000. Well, good. Work with what you got. Don't spend it all really quickly, right? Be thoughtful about it. But you have the opportunity to continue to build your business and say, okay, we didn't raise it all. Here's what we can do with what we did raise. Here's where it'll get us. And then we could go out for another raise. So again, you're more in control of, hey, we didn't have full success of what we wanted, but we can still accomplish things that we want to accomplish. So it puts you in the driver's seat. You can connect and reach investors you would never otherwise be able to reach with, right? So I can tell you I've grown my network dramatically of investors that I now know, have built relationships with, and am having success in raising funds from because of these platforms. I've met people on these platforms that initially put in $100, $1,000, $5,000, who become anywhere between $50,000 and $250,000 investors in my business over time. So you have an opportunity to get that initial investment, build a relationship with someone you'd never meet in the ether, right? Who lives in Alabama or lives in Texas or wherever, and you don't live there and you don't have a network there. Suddenly you do, and you can start building a relationship with them after they've invested, get to know them. And some of those people are going to become really vital to your business, but it's an opportunity to really start growing your network in a way that you otherwise would not be able to do so. It can become your predominant form of long-term capital. We are seeing more and more of what we call serial issuers basically go back every year, every other year, and continue to do crowdfunding rounds and Reg A+ rounds and build their base. And what they do is they continue to provide follow-on updates, quarterly updates, monthly updates when big things happen in the business, really good investor reporting. They're really thoughtful about letting their investors know what's going on with their business. And because of that, when they go to raise new rounds of funding, half the funds are already raised from the people who are already in their deal, right? They have these repeat investors, and that becomes a really powerful thing as it compounds. We just saw a company sell out $75 million in a Reg A+, one of the first companies to do it, who's been doing multiple rounds over many years, and it just keeps building its base, and it's starting to compound in value. You're getting investors that are looking for more than just a unicorn, right? The issue with traditional venture is that they're looking for unicorns or nothing. Your business might be doing 5 million in revenue and be deeply unattractive to a venture capitalist because it could only grow to be 500 million in revenue and be worth, $900 million because the revenue multiples are low in your industry. And you're not attractive, even though you're an exceptional business. Investors in this market are far and wide and diversified and looking for different things. And so there's an opportunity to raise capital from people who like the profile of business that you are. And they tend to be passive investors, right? Because even the ones who are writing 10 and 25K checks, for them, that's still a fairly small sum. So they have a very different lens in terms of how they're thinking about the investment. And most of your investors are going to be writing between $100 and $1,000 checks. So it's such a small part of their overall portfolio. They're not going to be hounding you saying, hey, when are you going to return, like a VC may be doing to you. So what are the challenges of equity crowdfunding? Well, the challenges are you don't just have one major investor who could come in and save the day, right? So maybe you are running off the cliff and you know it can take 4 to 6 months to be able to do a raise like this, and it's going to come in small increments. So you don't have that kind of savior that's there to save you when things really go awry. I worked at a company where they were going, they were sinking with the ship, and suddenly the VC was able to come in and give them a $5 million growth round, even though we weren't growing, and make everything look hunky-dory from the outside. You don't have that when you're doing this, right? You kind of have to live and breathe by what you're able to raise and bring in the door. Acquiring and building an investor community takes a lot of time, money, and effort. To think that you're just going to go out, one and done in 6 weeks, raise $1 million or $5 million you want, that's just not how it works. And that shouldn't be the expectation of how it works. So know going into all of this, that it's up to you to put a lot of time and effort into these rounds of funding. But if you build that investor community, you invest in that investor community, you provide lots of updates, lots of information, lots of webinars, really transparent, honest, all of that stuff over years, that builds and becomes deeply, deeply valuable. You're going to be far more public with your offering, right? So you're going to open yourself up to people poking and prodding your company. And I don't mean from like they can competitively compete with you because they know what your financials look like. I don't believe in that. But it's more so like when things don't go well, you have to be able to answer for that, right? You can't put some vanity metric out there and act like everything's great when they could see the underlying financials and you're burning through the cash on your balance sheet and you're not generating very much revenue, right? You have to answer for those fundamentals. This can be a potentially high cost of capital. I say if you only ever want to do one round of funding in this way and you think that the money should just flow in, that's not the case. And so then if you go out and you work with a marketing agency, you might end up having a high cost to spend on that first go round because you're not making the efforts to reach out to your community and building an investor network and doing all the things you need to do to make this effective, efficient, and fairly cost affordable. But if you're just kind of like one and done, you don't want to put a lot of effort in, you just want to work with an agency to do it all for you, then this does become very expensive very quickly. And there's a lot of regulations and rules that you're going to have to follow that you're not used to following in the traditional Reg D space, where really you can do anything you want. And lastly, time, right? This takes a while. It really does. And don't expect it to just come. It's going to take a while. And a lot of people get scared when they're putting months in and they're not seeing the exact results that they want. So what does the data say? Well, one of the other things that I think is really important to call out here is that only 17 companies in 2023 successfully raised the full $5 million. So people come to us all the time and they say, oh, we want to raise the full $5 million. Okay, how are you going to raise the full $5 million? You need to have an investor community. You need to have a rabid fan base that's engaged and understands investing. You need to be willing to spend on marketing. You need to know how to work the platforms and work their audience. You need to have a full update and content strategy. There's a lot that goes into having a successful raise. 17 of almost 1,500 raises is very small, right? So the odds that you're the $5 million company is very unlikely. Only 14 raised $4.5 million to $64 million, right? So again, a very small pool of companies. On the median amount was about $103,000, with only 30% reaching 300K or more, 20% reaching 500K or more, and only 10% reaching $1 million raised or more. And valuations, and this is why I said, it's about control, but not necessarily setting the terms. Valuations in this market have actually tended to be about 50% less on a rev multiple basis than the venture capital markets. People are looking for better fundamentals on these companies when they're investing as an individual, which is a really interesting finding, but something that you do need to be aware of. So all of this boils down to is like, Reg CF is super powerful. It can absolutely be a mechanism to raise a lot of capital for your business, but it is not a silver bullet. It is not super easy. It does require a lot of time, attention, and effort. And it should not be considered this like easy thing you can do because you were able to raise venture money. You could definitely do this. That's not the answer. This is a wholly different world. Now, the beauty of it, right, getting back to the things that make it really wonderful is the fact that any business can raise capital in this space, and we've seen it done across the spectrum. Whether you're a micro business like a pizza shop that just wants to do a term loan or a rev share loan to open up their second pizza shop, whether you're a small or medium business, right, who's only looking for a 3 to 7x return, right? You're a regional business and you're looking to, again, create 2 or 3 more locations or sell a few more government contracts, but you're only ever going to be a $10 or $20 million business. If that's priced right, there are investors who are going to be excited about something like that. You could be a large business that's doing 10, 20, 50, $100 million in revenue, but again, is only looking for a 3 to 5x or 10 to 20x, where again, you're never going to be a unicorn, but you're going to be a really good, really big business, which small, medium, and large businesses make up the predominant number of businesses in the United States. There's only a handful of truly mega businesses, unicorn type businesses out there, right? With your 100x, your 1000x type revenue multiple returns. The odds of that happening are very low. The odds that that's the business you want to build is in fact actually very low. So the beauty of this market is you could look like so many different things. You could be a micro business, a small business, a large business, a medium business, or shooting to be a unicorn. Every one of those has the ability to raise capital in this market if you position your deal right and you put in the work. Now, one of the other things that a lot of people get confused about and have this connotation of this market is that there's not quality companies in the market. And that's simply not true. You're amongst really good company when you're raising capital in this space. We have seen companies across the spectrum raise capital under Reg CF and be very, very successful. And I'll just call out a couple on here, right? I already mentioned Alto, right? They raised at a $30 million valuation on Republic. They've now done 2 additional institutional rounds, including one at $240 million valuation. Mercury raised $120 million from A16Z and then raised $5 million on WeFunder on the same terms. Substack raised $15.3 million from A16Z and then raised $5 million on WeFunder at the same terms. Liquid Piston is a company that's raised over $50 million across 6 rounds and grown from $0 to $8 million in annual revenue and is growing really rapidly now with massive government contracts, and they're really starting to take off. They went from like a true R&D project to a really large business that's growing quickly. Baby Quip is a founder who's had incredible success in their past endeavors. They've raised over $5 million across 3 rounds. They grew from $400K to over $5 million in annual revenue and are really starting to accelerate their revenue growth. We've already seen some great exits, like the couple that I have here on the right-hand side, where, for instance, Mevo, right? They raised a WeFunder at a $12 million valuation. I think it was within 9 months they were acquired by Logitech at a $50.2 million cash acquisition. All of that is to say is you're amongst good company and great quality companies when you do a Reg CF raise. So what are the things to know when you're going into one of these raises? It gives you a lot of power, it gives you a lot of control and a lot of opportunity. But individuals are savvy and they're going to ask you the hard questions. Just go on any offering page and check out the Q&As. They will ask the hard questions and expect good answers. Many of your individuals will become repeat investors if you keep them up to date and you build trust. This can become your main source of funding. I'm a living, breathing example of that. If you put in the time, you put in the effort, and you really dedicate yourself to having an investor relations experience that goes over the long term. But there are a lot of choices and challenges to navigating these waters. That's what we're here for. I'm more than happy to dive in. We'll be presenting an offer at the end. But just to quickly show you, at Raise Papers, which is our founder division, and at Kingscrowd, we basically have a solution that helps you go from determining if CF is right for you to determining if your valuation, what your valuation should be, the size of your raise should be, where you should list, figuring out your deal structure and form documentation, getting everything filed with the SEC, developing your investor outreach approach, so on and so forth. We can help you with everything from end to end, really figure all of this stuff out and navigate these new capital raising waters. I'll share this offer again later on, but wonderful to meet you all and glad I had the opportunity to share this with you.
Great. Thanks, Chris. Appreciate you sharing. And while we're waiting for Logan, we've got I just did a little survey out there. And Sam, if you can see, maybe I think with Logan, there may be some technical difficulty. I don't know if that's on our side. But it looks like most of the attendees are in the bootstrapping stage. And then, Chris, we have a question here while we could address it. It says, lots of time investment. Can you give a ballpark of how much work it is? We are a 3-person family startup. We want to try this. Is this a 3-person full-time endeavor to make successful rounds go?
Yeah, great question. It all depends on your expectations of what you're trying to raise too, right? So when I started this company, the first round that I did, it ended up being about 150K. It took me about 3 months to do. And I would say it was at least half the time I spent each day was going and meeting with investors, talking with investors, calling investors, emailing investors, LinkedIning with investors. So it was a lot of time and a lot of effort. In our last round that we syndicated on WeFunder, we raised $300,000 over about 2.5 months. And it was less than an hour of time a day because we built an investor community and we just kind of let them come in, right? So it changes over time, but that first go around, it's going to be a very time intensive effort and really driven by you, the founder.
Great. Thanks, Chris. And attendees, thanks for all your questions. This is a great segue to turn it over to Logan. And Logan is going to bring us home and talk about what Forecastr does and kind of his thoughts on this startup journey. Logan?
Yeah, thanks so much, Mike. And appreciate everything that you just shared, Chris. And it's very similar to my experience. It's a great segue into what I'm going to be talking about today, where Forecastr in total has raised about $15 million. The first round that we raised was what you would call today like a angel round or a friends and family round. And that was a $750,000 round. We oversubscribed here in Louisville, Kentucky, 27 angel investors, no check greater than 50,000. And that first round was significantly harder than all of the subsequent rounds. And I actually have a stat for you all that I think will help us anchor what I'm going to be talking about today, which is 2/3 of the capital that we've raised. Remember, we've raised $15 million. 2/3 of those have come from second checks, right? Not the first checks, but the second checks. So people that have already bought in on our company. And there's this saying in startups, I say it all the time, that your most likely source of new capital is old capital, right? And I'll tell you guys a really quick story here. There's a really well-known angel investor here in Louisville by the name of Jack Danahy. He used to work at IBM. He had a big exit with one of his early investments, and now he is one of the predominant angel investors in the city that Forecastr's headquartered in. And I had a conversation with Jack one time, and I asked him, what is the number one trait in founders that you look for? And the people that you invest in, what is the number one thing that you look for to know that it's a good investment? And I was expecting for him to say something like grit or intelligence or something that's more kind of startup foundery. But his answer really surprised me. He said it was transparency. He said that he has so many founders that he invests in that he will give them a slice of money and then he'll just never hear from them again. Right. And that is a very negative signal that, you know, there's a good chance that he made a bad investment, because that is that founder not being a good fiduciary. It is not being a practical and responsible founder and communicating to the person that bet on them to give them that really bet on the vision that they had for the company. So that's what we're going to be talking about today, is keeping investors informed, engaged, and happy. And, you know, I'll give you the bottom line on top, which is that informed, engaged, and happy investors are exactly the types of investors that write new checks into your company. So it's really practical information that can set you up for having a lot of successful fundraisers in the future. So whenever we talk about keeping investors informed, I like to think about things in terms of defense and in terms of offense. So defensively, what you're doing is you're kind of heading off against any surprises, right? If you have any negative surprise, like you have a massive legal bill that came up, or you just parted ways with your co-founder, or there's some massive headwind for the company that the investors did not expect at all, then that is going to catch them off guard, right? So you want to do what you can to head off those types of circumstances by keeping them in the loop, keeping them informed with the, you know, the inner goings of your business. This is important because most investors are smart people. A lot of them are ex-founders themselves, they're ex-operators. And if you keep them in the loop, what you're doing is you are activating an asset that you have to help you grow your company. I think a lot of people forget that whenever they raise money, they have a full bench of really important and really smart and successful people that are rooting on their business to succeed, and they just forget about that, or they ignore it, or they certainly don't take full advantage of that. By simply keeping everybody in the loop and letting them know what's going on in your business and how they can actually help, you are activating your human capital, which is the most important kind of capital out there. It's certainly more important than financial capital. So it's a great way to keep them in the loop. They can help you tackle your biggest challenges. And the last kind of defensive move that this can do is it can reduce information requests or inbound questions that investors have. So especially if you're somebody that has raised institutional funding like we have from larger, maybe, seed stage funds or Series A stage funds that are backed by pension funds or sovereign wealth funds. They have fairly intense reporting requirements, which trickles down to you. You're having to pump information out to them so that they can in turn pump that information out to their limited partners. So by being proactive and just getting a good system of pumping that information out without having to be asked for it, that you are reducing the amount of times that you are asked for those requests so that you can spend more time focusing on your business. So those are all the defensive strategies. Offensively, I've already said it, your investors are the best sources of future capital. So if you think about this practically, you can think about if you just secured a big pile of funding, now you have a bunch of new investors that you want to keep in the loop. Well, if every month you take the time out of your day to inform them of the good things that are happening in your business, the challenges that are happening in your business, but also what's happening with cash and what's happening to your runway, right? So once you get to a point where your runway is getting smaller and smaller and smaller, and you know that you're going to be needing to raise funds in the somewhat near future, these investors can start preparing for that. They can mentally prepare for it. They can actually start shelling away some cash and understanding what their own cash flow needs to look like in order to write another check. So it's a great way to be proactive, being on the offense and letting them know whenever cash shortfalls are going to happen. But then even outside of funding, again, it's activating that human capital. Investors are great sources of new business. They're incredible sources of new hires, referrals, pretty much anything and everything that you could want out of your business, anything that you could use help with. Your investors are sitting, waiting to help you out. And so it's a great way to just activate that resource. So I want to talk about what that looks like practically, right? If we want to get tactical here, what does it look like to keep a good, strong cadence of transparency? Well, I think that you'll find that it's not as hard as it may seem. So at the very minimum, what we highly recommend, I cannot recommend this enough, is just sending a very simple but powerful monthly update and sending it at the same time every month. And you don't just have to send this to investors. You can send this to your entire network, anybody that's interested or along the journey for your company. So Forecastr has been doing company updates, monthly company updates now since 2018. That's 2 years before our company officially even incorporated. So we have been doing this steadily, monthly updates, right? If you're a potential investor, if you're a potential partner, a potential employee, a customer, anything, then we have you on our monthly update list. And we talk about what's going right in the company, what's going wrong with the company, what our metrics look like, what our cash balances look like, our future fundraising plans, just giving you a peek behind the curtain just to understand what's actually going on in our business. And simply by doing this, it takes about an hour a month. We have landed countless customers, major partners. And I'll shout out Gust if anybody uses Gust out there. They're solely a partner of ours because they were on our monthly update list and they were bought into our journey. We've gotten multitudes of investors, and it's just one of those things that just pays incredible dividends, and it doesn't take that long to do. So we use PaperStreet, 1 hour a month, just send out a monthly update. And that's a great way to keep your investors updated and very, very little time cost. Quarterly, what we really recommend, especially in a post-COVID world where everybody's on Zoom anyway, is just doing a quarterly meeting, right? A quarterly virtual meeting. And this can be a, ask me anything type of meeting. You don't even really have to prepare for it whenever we do these at Forecastr. It's just my co-founder, Steven, and I on a call. We invite all of our investors, and we have, close to 100 investors at this point. And we say, look, just show up. Steven and I are going to be here, and we will be ready to answer any questions that you have. We don't have anything prepared. We don't have slides to go through. We are literally just here to have any sort of conversation, any questions that you have, and to answer any questions that you potentially could have for us. Very little time cost, incredibly powerful. You are just opening the doors and saying anything you need, come to us. And again, this just shows you are being a good fiduciary, right? You are being transparent, you're being open, and you're letting them know how you're spending their money and what's actually happening with their money. Then annually, if you can swing it, we highly recommend an in-person meeting. So if you can get all of your investors together for maybe a dinner or a meet and greet at the office or something like that, it may be harder if you're remote, but super powerful to get people all together in the same room. I think that that can really pack a lot of power, and it's something really, really great to do just to build a little bit more connection between your entire investor base. You'll notice this little green dot here at the bottom, evergreen, that's the data room. So very important to keep a updated data room at all times. And if you're not familiar with what a data room is, it is basically a repository. It's like an online filing cabinet for everything and anything an investor could ever want to know about to invest in your business or re-up in your business. So it's going to have monthly financials. It's going to have a link to your financial model. It's going to have a link to your most recent pitch deck, all of your employee agreements, all of your incorporating agreements, all tax information, all of that is going to be online, neatly organized in your data room. So at any time, if any of our investors wants to get anything on our business, any piece of information, they've always got a link to our data room. It is always updated. They can just go in there and find it for themselves. Again, that reduces information requests and good fiduciary, right? I'll note here that there's a reason that there's such stringent requirements to become a public company. Whenever you become a public company, you are forced to overly report on the ins and outs of your company. And that is one of the highest barriers to entry to being a public company, outside of just it being really hard to go public. But there's a reason that this is important, because it is very efficient to have a market that is operating on the most up-to-date and reliable information. And that's really what you're trying to simulate here, is a free open market where information frees freely back and forth. So I want to show you really quickly, and then we'll get to Q&A, what this looks like for us in person. One of the reports that we send to our investors every single month is what we call our monthly financial health report. You'll see how detailed this is. And just FYI, this is also what we put together for all of our clients here at Forecastr to send to their investors. So what we do is we have a forecast that we set, that we adhere to, and we only update that forecast once a quarter, so that we can go in and we can see, based off of what our goals were or our estimates were, how do we compare? So we actually missed our revenue forecast, but we beat our EBITDA, or you can think net income forecast, because we didn't spend as much. Our operating expenses were lower, but our cash was a little bit lower than we expected it to be too. I can go into all the details of how we acquire customers and what we expected versus what actually happened. All of the details of our funnel, all of our revenue. Note all of the commentary from analysts and CFOs. If any investor wants to go in and see what is going on with the business at any point in time, this is their report. They can go in and they can read every line, and they can see what did they think was going to happen, what actually happened, why is there a difference, and what is all of the underlying mechanics that lead to this. It's very, very powerful. And this is one of the most powerful slides on there, this cash analysis, where I can show this is what our cash is today, and this is what we're forecasting it to be in the future. Now, this is an older report, but notice here, this increase in cash in August of 2024, right? And we can show what we're planning on doing to shoot the gap and avoid that cash shortfall. In this case, we raised money. So accompanying this email, we could say, be on the lookout, because in 6 months, we're going to be raising money to avoid this cash shortfall. So again, it just allows them to get prepared. It allows them to get on top of things and really head this off. So I'll cut it off here. I know that we want to do some Q&A. I know we got about 7 minutes left. So Mike, if we want to go ahead and do that, then we can go ahead and jump into that.
There we go. Great. Logan, thank you. Okay, so I've just been kind of copying and pasting questions here. Starting with MW has a question. Raised friends and family heading into pre-seed now, wondering if crowdfunding has a role to play as a type of bridge that delays raising from traditional VC until we're more mature and ready to spend at the pace VCs expect. Great question. Chris, do you want to tackle that?
Yeah, I'd be happy to. Yeah, it's perfect for that. I think crowdfunding could fit anywhere in the capital stack. But one of the places that I think it is great for is in that, okay, we don't feel like we're ready for venture, or we don't feel like we're in a position of leverage, right, where we'd have to accept whatever terms come our way. It's a perfect way to say, okay, let's extend our runway. Let's be able to hit these new end goals. And then we feel confident being able to go to market and raise that capital. So absolutely makes sense. But again, just think about timeline, right? It from today, if you said, yes, I'm going to do it, your first time around, it's probably going to take you 6 to 8 weeks to get launched, and then 2 to 3 months to run the actual capital raise. And how much are you looking to raise, right? First time out, reasonably, if you're going to be putting in a good amount of effort to get that first 50 or 100K in the door with some of your current investors and some new investors, and then really working the deal, somewhere between 250 to 500K is probably reasonable. But if you're looking to raise $1 million plus on that first go around, you have no marketing budget or anything like that, then it might not make sense. And you might want to go more of the institutional way. But absolutely, if you need a meaningful but not crazy amount of capital and you have some time to do it and you're willing to work the deal, 100%, I think it's a great fit.
Great. Chris, thank you. Logan or Mike, you want to add to that at all?
No, that's a good answer to me.
Okay, good. Another question from DW. What would you give in return if the company is pre-revenue? Equity? And Mike, maybe you want to kick us off on that one.
Given in terms of equity, I think that you got to think about these different levels of investors. You have founders who are foregoing income and expenses in exchange for equity, in which case you use a slicing pie model. If it's an angel investor, someone who invests their own money and amounts that are too small to fund your operation, I would give them a convertible note or a SAFE agreement, simple agreement for future equity. If it's a crowdfunding campaign, I would give some kind of debt instrument for a small raise, and maybe a price round for a bigger raise and a venture capital raise.
Great. And Chris, Logan, want to add to that?
I'll just jump on there. In pretty much all cases outside of the debt, if you're doing like a crowdfunding thing, you're going to be giving away equity. It may not be equity right away in the case of a safer convertible note, in which case it's going to convert in the future. But 9 times out of 10, if somebody's giving money to a startup, it's because they want a piece of that pie.
Right.
Great. Okay. Okay. Next question. I think this is for you, Chris. This is from N. What platform did you say was used for monthly updates?
Oh, that was for me, actually. That was
yeah.
Paper.
Oh, okay.
Yeah. Paperstreet.vc. Techstars company, really strong company. You can also use MailChimp for something like that, but Paperstreet's used for investor updates.
Great. Thanks, Logan. Okay. Another question. Investor relations. Our friends and family had a lot of small check investors. How do you clean up the table a bit? I hear institutional investors can get scared away from this. Or do I focus on getting those small checks to increase their investment in the next round? Any advice?
I can take this one real quick. Curious to get other thoughts. So I've heard that rumor before that institutional investors are afraid of a lot of small checks on the cap table. That's not been my experience. I've advised a lot of different companies. My company specific, like our first round of funding had 27 angel investors, no check greater than 50,000. We then went on to raise 2.5 million from one of the biggest VC funds in San Francisco. Absolutely no issues whatsoever. And I've never once heard of an institutional investor having any issues with that. So I think it's mostly a myth. I don't think it's nearly as big of a deal as people think that it is. But if it is something that you're bumping up against, I would say there are plenty of ways to handle that. You can consolidate all of those investors into an LLC, and you can have that LLC be one entity on your cap table. We've walked some companies through that, but my TLDR is I don't think it's as big of a deal as people think it is.
Great. And then Chris, maybe you have any clear color to share on like which platforms use SPVs or whatnot?
I mean, most of them have it at this point, and like WeFunder has it. Start Engine has a transfer agent set up in a way where like basically you can manage it all as one, and they manage a lot of the complexities of it for you. Net Capital has it. And then if they don't have it, you could always have an SPV set up by a lawyer, and there's pretty standardized documentation out there of how to do it for crowdfunding rounds at this point. The one other thing I will say, especially, we're still coming off of like the 2022 age, 2021, where people were putting out ridiculous preferences and liquidation preferences, this, that, and the other thing. Investors will care a lot more about having a bunch of names that are passive and easy than a few on there with crazy liquidation preferences and things that are actually scary and terrible. So you're better off with a bunch that are easy to deal with than a couple that are really, really difficult.
I 100% agree with that.
Great, thank you. Okay, we have a couple of time for maybe 1 or 2 more questions. Is there any restriction to a company business model that are funded through crowdfunding?
There isn't. No. You have to be a US based entity, and the intellectual property and predominant business needs to be in the US based entity. Other than that, no, there really isn't.
Okay. And also just with investment crowdfunding or Reg CF, you can do debt and equity. Typically
right.
for smaller, more Main Street businesses, debt is a better security type, because I think it's hard to get acquired when you're a restaurant or maybe a smaller type entity. Okay, and then let's wrap it up. It looks like this is crowdfunding a way to simplify friends and family. I'll let anyone take that one.
Yeah, I mean, I'll start real quick. The answer is absolutely yes. And the beauty is, not only does it simplify it because you can manage all those one checks again as one line item and in one place, and do it in a digitally native way, but also everyone in your friends and family can do it, right? So if you don't come from a wealthy family, or you don't have people who write 25, 50, 100K checks, you'd have someone write $100 check. So everyone in your family becomes an investor in your business, which I think is fantastic. So absolutely, it's a great way. And it becomes, you can leverage your friends and family as maybe the first 25, 50, 100K in the deal. And then that gets people excited about your deal on a platform like WeFunder, Start Engine, Net Capital. And now you can raise more from their crowd and start building your investor community.
Awesome. Great. Well, we're at the top of the hour. I just want to give a big thank you and a kind of a virtual round of applause to Mike, Chris, and Logan for making this a great webinar. And now I just want to highlight, can everyone see my screen with the special offer from Forecastr? Super. Okay. Logan, you want to just give a quick little wrap up on your offer?
Yeah, super quick, guys. So offering 20% off of an annual subscription, first year discount for anybody. We're also going to waive a $500 implementation fee. Just to let you all know how we work, we build financial models using our software, but we also pair every one of our clients up with an analyst to help them unlock the power of finance. So you don't have to figure everything out on your own. You're going to have an expert guide you the entire way. So if you are interested in that, I think Savon maybe dropped a link in the chat, but if not, I'll dig that up and share it with you guys. Just use that to get in touch with us, and we'd love to see you on the other side.
Thanks, Logan. And then Chris, a little bit on Launchbox.
Yep. So Launchbox is really kind of taking you from day zero to launching your first crowdfunding round. Doesn't have to be your first either, but we're going to set you up with figuring out everything from, does it make sense for me? How does this work? If I'm going to do it, what should my valuation be? What security type should I offer? How much can I expect to raise? What does my budget need to look like? Who are all the vendors I need to work with? What does my documentation need to look like? What are my timelines? Plus providing intros to all of the key vendors, platforms, so on and so forth that you need, and really going about this in a thoughtful way so that you set yourself up for the best chance at success in your crowdfunding round. It's typically a $3,000 consultancy service, but for all of our attendees here today, it's $1,500. Go to raisepapers.com and click on the Launchbox solution, and you'll have that discount baked in.
Sweet. Thanks, Chris. And then Mike?
Yeah, there was a question about what investors don't like, multiple checks, too many checks. What they don't like is fighting founders and deadbeat founders that have left the company. So getting your split right, going into your crowdfunding, going into your angel raise is going to be important. So I went over a little bit of how Slicing Pie works, and you can find a full course with a copy of the book and spreadsheets and all kinds of stuff to learn how Slicing Pie works on my website. And use webinar 50, you get half off, and makes it $37. It's pretty cheap. And my main goal in life is to teach the world how this works so that everyone can get from ground zero to an investment round without killing each other.
Mike, thanks so much. Well, that concludes our webinar, and I just want to say thank you again for sharing with us. I apologize for technical difficulties, but we will have the recording and we'll get that out to you. So everyone have a great day.